Hello and welcome back to the Bright Founders Talk podcast from Temi. Temi is an international software development company that designs, builds and delivers software for sustainable businesses and promising startups. My name is Chris and today's guest is someone who has a wealth in investment, capital management, as well as the founder of a global financial services company. Horacio Marquez, welcome to the podcast. How are you doing today?
Very well, Chris. It's a real pleasure to be with you today and with the audience.
Pleasure to have you. So, as always, got the quick fire questions. The first one, what is your favorite productivity hack while working from home?
Well, basically, I have to say that I'm a very, very big chess player. And in chess, concentration is everything. So basically what I do is I shut everything off so that telephone, all the electronics, etc., other than my computer, I just concentrate. And in that way, I can get my productivity through the roof. Just avoid distractions. That's the number one.
Do you have like a little room where you go to and you sort of close yourself off or just anywhere in the house?
No, basically where I'm right now, which is very, very quiet.
What is something new you would like to learn outside of work?
Outside of work, languages. The more languages you learn, the more you learn from other people, because different cultures have different insights into different things. So, for example, the Eskimos have something like 16 names for snow. Why? Because for them, it's a question of life and death. A different type of snow might mean that you just plunge through the snow and die. So that it's amazing what you can learn from other cultures.
That's true. How many languages do you speak right now?
I don't know. Let me think. Spanish, English, Portuguese, a little bit of French, a little bit of Italian, Latin, and I would love to really become a lot more fluent in French and Italian as well.
Very jealous. The last one for the quickfire ones. What did you want to be growing up?
Well, growing up, I always want to be a good guy. I always want to be a good person that gets along with everybody. And it's what, later on when I studied business in a 6-year program at the University of Buenos Aires, I learned of this sociologist, Durkheim, that had definition for leadership. And in leadership, he defined leadership as three types of leaders, basically. Number one, the kind of tyrannical leader. Number two, the bureaucratic leader. And number three, the charismatic leader. And I always wanted to be a charismatic leader. And the charismatic leader is someone who leads by serving others, by basically making the best, thinking and making the best of every person in the team, being concerned about them and making sure that they empower them to be their best and to contribute their best to the whole, and leads by example, by doing the hard things himself and always looking for everybody.
Mm. And so we're touching on that a little bit more because, I believe we studied at a few different places. Well, was it Buenos Aires and also the US? I'm not sure where you studied in the US. Was it Virginia or?
I came to the US for an MBA at Carnegie Mellon University, at Carnegie Mellon's University School of Business, which basically at the time was it was ranked number 3 in the country and the second hardest to get through, because it was Carnegie Mellon's business school claims that they invented a management science. Basically, what you had at the time was Harvard Business School that was using the case method. The case method was originated in their School of Law. And it's based on cases. You look at the case, you analyze the case, and you resolve the case. At Carnegie Mellon, they decided to use different sciences, hard sciences, and apply them to everything. So even in human resources, we had formulas for employee satisfaction, for example. And so we were taught very, very strict ways of analyzing problems in the different facets of business, always applying hard sciences. And that gives you a tremendous insight. For example, something that has been incredibly useful for me throughout my career in predicting, rather than predicting, in seeing where to invest, is using Bayesian statistics, where you basically say, for example, you have two possible situations. For example, in the U.S., hard landing or coming up, either hard landing or soft landing, and in any decision theory model, it would be 50-50, right? But you can, over time, you can learn to handicap those odds by studying all the tea leaves around each one of them, different factors that affect the probability of a soft landing or a hard landing, and assign your own probability. With time, you get better and better at assigning those probabilities, and you end up getting outstanding results. So, for example, many years ago, I was writing financial newsletters, and over 3 years, I made 57 recommendations. I made money in 55, and my average return per recommendation in one of the newsletters was 25% per recommendation year after year, and in the other one it was 27%. It was an incredible track record, and it just came because I used a matrix system of analyzing investments that started by analyzing the economy, basically spending 50% in macroeconomics, because a rising tide raises all boats. So you want to be investing in economies where what you see is an acceleration of the economy, and investing specifically in the industries that are going to accelerate the most, because stock prices vary in direct proportion to the second derivative of profits. That is, a change in an acceleration in the rate of change of profits. So, for example, a typical example is you see a company that has been trading, going up at a certain rate, at a certain slope over time, and that's because they're pricing a certain rate of growth in profits. What you're looking for is a catalyst that will accelerate that rate. So when you have a company and all of a sudden that catalyst occurs, boom, the stock explodes up, and that's exactly what you're looking for. So I became very good at picking those catalysts and basically profiting very, very big time with that.
Just because you studied in two different places or two different countries, did that sort of shape your outlook on what you can invest in or what you wanted to do moving forward?
Definitely. Believe it or not, Argentina, it has been one of the most mismanaged economies in the world. Argentina is an extremely profitable country, a rich country, and because of mismanagement, growing up, I remember that the rate of volatility in the economy was enormous, and there were times where Argentina had 4 economics ministers in a single year. Now, if you're looking at the economy and they keep changing the economics minister, and each economics minister comes with a different set of parameters in how he's going to manage the economy, what you learn very, very quickly, economics, because you see, well, this guy was lax on, he had big fiscal spending and big monetary issuance, and that produced a certain effect. And this guy just tightened fiscal spending but kept the monetary issuance high, and that produced another effect, and so on and so forth. So in a single year, you learn a lot about how different things respond, and basically every Argentinian becomes a kind of some kind of economist. You could jump on a taxi, and the cab driver will give you a lesson on what he expects the dollar to be during the next month or inflation. I learned how to analyze companies at Bank of Boston in Argentina, which at the time was the largest international bank in the country and the second largest bank in the country, had been there since 1906 and was extremely conservative. And I was analyzing companies in an environment with 30% inflation a month. Think about that. You're getting the December 31st numbers of the company, the annual numbers. You're getting them in April, and there's been already like more than 100% inflation. So the numbers that you're looking at no longer exist. So you have to make kind of a mental projection of how inflation affected the different areas of the balance sheet and how it affects the income statement. And that became untenable, so Argentina invented inflation accounting. By inventing inflation, and we had 4 different inflation accounting methods, and that at the time I was studying at the university, I was studying full-time at the university, simultaneously working full-time at Bank of Boston, which was extremely difficult, but I really wanted to push myself. One of the constants in my life is I always get out. If I feel comfortable at some point, I say, no, I need to push myself some more. So I make myself uncomfortable in order to grow. That's the only way to grow. So by doing that, what happened was that I was learning the inflation accounting while analyzing companies at Bank of Boston. And that gave me and I was in a trainee program at Bank of Boston that was at the same time very intense. That gave me an incredibly good understanding of accounting, which, by the way, that helped me a lot when I went to business school. I was the second best in accounting in the class, and that helped me throughout my entire career. Accounting is one of my strengths.
You were primarily in emerging markets, so I was curious whether you were sort of looking at, South America in general, but from a US perspective, like with your knowledge and then thinking for the companies in the US, how can we grow with these markets?
Yes. Basically, I was looking at, I was analyzing both country risk and companies all over emerging markets, mainly Mexico, Brazil, Argentina, and Venezuela, but then also tangentially, because those markets are smaller, countries like Peru, Panama, Costa Rica. And the thing is, when you were looking at countries that have very high risk and economies that are very volatile, and those economies had just come out of their defaults by refinancing their defaulted debt into Brady bonds. When you're doing that, those economies are still very fragile, so you have to be extremely careful as to where you're going to invest, in what type of companies you're going to invest, because the probability of defaults are much, much higher than in investment grade in the United States and in Europe, for example, in Japan. You are a lot more careful and detail-oriented than when investing in companies in the U.S. But that mental gymnastic of analyzing in very detailed form came extremely handy when I then moved to analyze companies in the United States. In the United States, as you see, I was head of credit of a very large asset management company. We had 20 billion, and I was the head of global credit. And I was following 26 countries, more than 200 companies, more than 200 structures. Within those 200 companies, all of which were investment grade rated, there was WorldCom and Enron, for example. And it took me only 40 minutes to look at Enron to realize that there was a big problem in a special purpose vehicle that was incorporated in a fiscal paradise in the Caribbean and had no notes. And that was responsible for 40% of the cash flow. So obviously, you cannot approve that credit. So, 40 minutes, and I got rid of Enron. And then like 2 weeks later, I was looking at WorldCom, and I realized that 70% of the sales were from international, domestic, long distance, and basically I had done some work with prior to that in the .com boom that was caused by the Y2K problem, where a whole bunch of investment in tech had to be done globally to deal with that problem, and basically I knew that because of voice over IP, international and domestic long distance prices were going to collapse to zero eventually.
Wow.
So that was an easy one to see. And like that, over my entire career, I've had zero defaults. I had never lent money to a company that did not pay.
Wow.
I have never been invested.
What's the secret behind that?
In a country or a company that defaulted. So, for example, we got out of Russia December 30 of 97, and Russia defaulted a few months later.
Wow. You could see it coming? There were certain traits that were quite distinct when the country is about to default, or a business, sorry.
Yes, and well, one of the things that people do not look at, and I think it's the most overlooked factor in investing, is character. The first C in credit is character. So if you're dealing with somebody and the character is not there, if the people that you're dealing with are not honest and are playing all sorts of tricks, you just don't invest, because they're going to find a way of taking advantage of you. And I actually had visited Russia in a couple of months before, and I got to see all the banks, the Ministry of Economics, the central bank, and what I saw was it was, number one, a lot of inefficiency. I saw that a lot of capital had come in and was not being allocated properly. So the free markets were not working very, very well. They were directed by the system of oligarchs that you see that were close to the government, and therefore, and I saw a predatory type of behavior by all the locals. And I said, this is not the place to be. I think they're taking a lot of our capital to come out of the very difficult situation that they're in, but they're not going to be able, the number one, the rates of interest that they were paying were very, very high, and they will not be able to pay them back.
Interesting. Yeah, it's quite interesting in terms of character. But
for example, in Mexico in 94, Mexico actually published their current account, and they had towards the end of the year, at the beginning of December, they came out with their current account numbers, and they had an 8% an 8% deficit in their current account. And I knew, because of experience, that no emerging market had survived once their current account becomes higher than 5%. So they were at 8%, so it was a kind of a no-brainer. I went to my boss and I said, hey, we need to get out of Mexico. And we did. So it didn't, the tequila effect didn't hit us. And a few months later, I also saw that Argentina had reduced 2 taxes, and I did the numbers, and that led me to go to my boss and say, hey, listen, we need to get out of Argentina, because again, Argentina, instead of finishing the year at their agreed upon target with the IMF of 1.7 billion, and by mid-year they were at 1.2 in 1.2 surplus in their primary fiscal surplus. They had agreed 1.7. They were overperforming, and everybody loved Argentina, and we loved Argentina. By changing those 2 taxes, my numbers show that told me that they were going to lose all of that, and that would be terrible. And so we got out, and we were the only emerging market fund that got out of both Argentina and Mexico.
Now with the current company you founded yourself after this experience, GFMIS, how did that idea come about? Like, did you always want to go it alone at some point? Or was it something more spontaneous that just kind of snowballed?
It's basically, it was something more spontaneous. What happened was I was writing financial newsletters, and I was having a lot of success. And then 2008 came, when all the markets blew up. And in 2008, I made one mistake, which is I thought that Lehman Brothers was going to be saved, and I thought that it made all the sense in the world to believe that, because Lehman Brothers was a systemic institution, financial institution, and needed to be saved. However, it wasn't possible to save it. I later did a whole bunch of research on that, and I realized that it was impossible to save it. So actually, the U.S. Treasury did the rational thing to do. They didn't kept throwing good money after that. And then what happened is, after the blow up, the entire global financial system, in order to basically come out of that very, very big hit, eased interest rates very, very strongly, and the U.S. started quantitative easing. When that happened, basically what you're trading is you're basically second guessing what the Fed is going to do with the easing this month and when it's going to happen, et cetera, et cetera. So I kind of said, yes, I can just print money because the market will keep going up and up and up. But am I adding much value when clients could just buy an ETF for the S&P 500 and just sit on it? And I decided, no, let's try to add value, to create something. I always wanted to create something, and at the time, for 3 years in a row, there was this entrepreneur, the co-founder of OnePack, that had he was an attendant at the financial seminars where I spoke, that came to me and asked me about his company. And first time I told him, well, he wanted me to join his board and help him. And I said, well, your company is too small, and what you're doing is not scalable. And why don't you look in this other direction? So the next year he came back, and he was closer, but not quite. The third year, which was actually right after the Lehman blow up, I said, you got it. You have the first mover advantage. You're in a sector that does not exist yet. You're going to create it. Nobody even knows that they need this. And so, yes, I'm in. So I joined their board, and therefore I stopped writing financial newsletters, and I became initially incredibly involved in restructuring the board, restructuring the business plan, raising the money, restructuring the capital base, doing all sorts of things, because, as you know, startups are full of problems.
With your own company, what was the biggest challenge you had to overcome? Because I know, it's your first time starting. I know you were part of others, but what was the biggest thing you had to overcome?
Well, the biggest challenge, I think, is explaining to people what you're doing, because it's a new company, and I have an eclectic background, and that's basically by design. I normally, as I expressed earlier, I'm an avid learner, and once I get into a sector, once I dominate that sector and I acquire a mastery of that sector, I say, well, what's next? And so I started in emerging markets, then I moved to developed markets in bonds, then I moved to equities, writing analyzing companies in equities, and then I moved into startups, and I'm doing a number of things. Like right now, I'm looking at a medtech that could change the world. Basically, it's basically an existing technology that's underutilized and can be scalable globally. It could be tens of billions of dollars, and basically I'm looking to acquire that company and add AI and epigenetics, and basically resolve some chronic situations that people around the world are living with.
So you feel like you've incorporated AI into what you do right now. You haven't found it to be something scary that might.
No, not at all. AI, listen, I mean, there's a lot of mystery about AI. What is AI? Think about what AI is. All AI, by the way, Carnegie Mellon invented AI. Herbert Simon, professor of psychology at Carnegie Mellon, Nobel Prize of Economics, was one of the leaders in inventing artificial intelligence back in the 50s. And so I read about AI back in the 80s. Think about that. It was called machine learning.
Now it's a bit of a buzzword, right? It's kind of very popular the last year.
Right.
The average person, but yeah, I see.
Well, what happens is that it has been developed for a very long time, and it takes a long time to develop. But until you get to a critical point where you can say, well, now it's become useful to the point that it goes beyond a certain very restricted uses, and it can be used for a lot more verticals, even by regular people without any training. So, but what AI just is the pre-programming of certain searches and decisions. That's all it is. Another way of thinking about it is like an expert system, where you take somebody that knows a subject very, very well, and you program the system so that when the system sees a certain number of conditions, they take a certain decision, and otherwise they go some other way. So you can program everything, but it takes number one, experts to do the programming. Number two, a lot of time, and that's very expensive. So
yeah, seems like it. Well, just running a little bit out of time, so I just want to ask you my final question. I think it's very interesting, especially from your point of view, someone so experienced. If you could shadow any CEO or be a part of a company for a couple of weeks and see how they do things, who would it be and why?
Jamie Dimon, the head of the largest and best managed bank in the world. Why Jamie Dimon? Because number one, and this is why I went into banking first, because through a bank, you see the entire economy. You see all the industries. You see the economy, the macroeconomics, and you see the microeconomics, and you see every industry. And you see all the entire economy. And then at the same time, one of the trickiest things about banks is managing risk. And JP Morgan is the master of that. JP Morgan invented risk management. And well, risk management was always there, but JP Morgan invented risk management with something called value at risk, whereby they wanted to know how much risk they had in their balance sheet after the markets closed at 4 p.m. every day. And that was something revolutionary at the time, and they've gone way, way beyond that. So if actually today there's an article on Bloomberg about how many U.S. banks had a hard time this year unless they were named J.P. Morgan, and that has been a constant for decades. For decades, J.P. Morgan is a bank like a bank should be, which is pretty boring because they're very well diversified, and they're always worrying about what can blow up and making sure that it doesn't blow up in their balance sheet. So I would love to sit by Jamie Dimon as a fly on the wall and see how he manages that bank.
Brilliant. All right, very interesting. Well, wish you all the best. Thank you for your time today, Horacio, and good luck moving forward with your investments.
Thank you very much, Chris. It's been a real pleasure, and congratulations on your program. It is fantastic. I never miss an episode.
Thank you very much.
All the very best.